Hello everyone. Today I'm going to be talking about transfer pricing background. World War II. In 1942, the Second World War broke out. The World War II ends when the Allies, led by the United States, dropped two atomic bombs on Hiroshima and Nagasaki on August 6, 1945. About 200,000 Japanese civilians died. On September 2, 1945, the surrender was signed in Tokyo. Regardless of that, the founding of the United Nations. As World War II was about to end in 1945, nations were in ruins and the world wanted peace. Representatives of 50 countries gathered at the United Nations Conference on International Organization in San Francisco, California. The United Nations was established in 1946 after the Second World War with the purpose of preventing the recurrence of the wars of the first half of the 20th century, which brought great grief to mankind, and to safeguard international peace and security. The Plan Marshall before the OECD. The Plan Marshall was a US sponsored program designed to rehabilitate the economies of 17 Western and Southern European countries in order to create stable conditions in which democratic institutions could survive in the aftermath of the World War II. It was formally called the European Recovery Program, and it is the president of the OECD. So the Organization for Economic Cooperation and Development, OECD, was established in 1961 as a forum for governments to share experience and seek solutions to common economic and social problems. The OECD acts on behalf of and in collaboration with its member governments to promote policies that will improve the economic and social well-being of people around the world. In practice, the OECD promotes free market policies and trade. Mexico enters the OECD. On May 18, 1994, Mexico became the 25th member of the OECD. The decree promulgating the Declaration of the Government of the United Mexican States on the acceptance of its obligation as a member of the Organization for Economic Cooperation and Development. It was published in the official Gazette of the Federation on July 5 of the same year. On an equal footing, Mexico analyzes the public policies of the member countries. Some of the specific benefits of Mexico's entry into the OECD are: 1. Public policies in different areas are contrasted with experience of best practices at the international level. Number 2. Public administration in Mexico has been strengthened. Number 3. Different sectors of the country can also make use of analysis of relevant information. And number 4. The OECD has done a good job in contributing to a better understanding of some public policy issues in Mexico. The Panama Papers. The Panama Papers are 11.5 million leaked documents that were published beginning on April 3, 2016. The papers detail financial and attorney-client information for more than 214,000 offshore entities. The documents, some dating back to the 1970s, were created by and take from former Panamanian offshore law firm and corporate service provider Mossack Fonseca. The documents contain personal financial information about wealthy individuals and public officials that has previously been kept private. While offshore business entities are legal, reporters found that some of the Mossack Fonseca shell corporations were used for illegal purposes, including fraud, tax evasion, and evading international sanctions. The Economist and the International Monetary Fund describe an offshore financial center or tax haven as a jurisdiction whose banking infrastructure primarily provides services to people or business who do not live there, requires little or no disclosure information when doing business, and offers low taxes. The most obvious use of offshore financial center is to avoid taxes. The Economist added Oxfam blamed tax haven in its 2016 annual report on income inequality for much of the widening gap between rich and poor. For example, in this case we have John. John has a company in Mexico, and in Mexico the tax rate is 30% on your profits. So the company makes revenue for 5 million and expenses for 3 million. So they have profit for 2 million. The tax rate in Mexico is 30%. So essentially the company have to pay 600,000 to the government. But what John do is to create other subsidiary in other jurisdiction considered tax haven, other company offshore. John do that through the law firm Mossack Fonseca. Mossack Fonseca is who has the knowledge about tax havens, how the company's offshore works. So in this case, John create other company offshore, let's see, in Delaware, that is considered a tax haven, and the tax rate is 5%. So John shift the profit to the other jurisdiction for 1,950,000. And now in Mexico, John have revenue for 5 million and now expenses for 4,950,000 because John shift the profits to the other jurisdiction, to the other company. And in Mexico now only have 50,000 in profits. The tax rate is 30%. John only has to pay 15,000 in Mexico. In the other jurisdiction, it has revenue for 1,950,000 and the tax rate is only 5%. And the tax is 97,500. So before John was about to pay 600,000 in Mexico, but now he has to pay 112,500. He saved 497,500. That is a lot of money that John saved on taxes legally. So base erosion and profit shifting. Base erosion and profit shifting refers to tax planning strategies used by multinational enterprises that exploit gaps and mismatches in tax rules to avoid paying tax. Countries have worked together to provide a range of estimated reasonable statements about the magnitude and economic impact of BEPS. According to the information available today, the loss collection caused by BEP is estimated between 4% and 10% of global collection for corporate taxes. That is at least between 100 and 240 billion dollars annual. That's a lot of money. So that is why the OECD developed transfer pricing. So the Organization for Economic Cooperation and Development first published its transfer pricing guidelines for multinational enterprises and tax administrations in 1995, reflecting an ongoing focus on international tax challenges, including transfer pricing issues. The OECD has since continuously revised and supplemented the guidelines. Transfer pricing is a mechanism for determining arm's length principle in related party transactions, often in the context of cross-border related party transactions. So, what is the arm's length principle? Well, first of all, what is an arm's length transaction? Well, an arm's length transaction is considered when the seller and the buyer has no pre-existing relationship. Why? Because when there is no pre-existing relationship, the two parties are acting in their own best interest. The seller is looking for get the highest price possible, and the buyer is looking for get the lowest price possible. So this is the accurate representation of fair market value. This is a normal deal. On the other hand, non-arm's length transaction is considered when the seller and the buyer has a pre-existing relationship and the price is artificially low. So this could happen in multinational enterprises level. For example, in this case, in Mexico, United States, and Brazil. For companies to be considered related parties, they have to be connected through a commercial relationship. When one company has direct or indirect control or in capital control or management of another company, they are considered related parties. The golden rule is the price should be the same between related parties, and if they were independent to each other, the price should be the same. That is transfer why the OECD create or develop the transfer pricing guidelines. So the OECD transfer pricing guidelines for multinational enterprises and tax administration has 10 chapters. Chapter 1 is the arm's length principle. Chapter 2 is the transfer pricing methods. The chapter 3 is comparability analysis. The chapter 4 is administrative approaches to avoiding and resolving transfer pricing disputes. Chapter 5 is documentation. Chapter 6, special consideration for intangibles. Chapter 7, special considerations for intragroup services. Chapter 8, cost contribution arrangements. Chapter 9, transfer pricing aspects of business restructurings. Chapter 10, transfer pricing aspects of financial transactions. The chapter 2 is the transfer pricing methods. There are the 5 transfer pricing methods. The one is compatible uncontrolled price method. This is the main transfer pricing method and the most used. Number 2 is resale price method. Number 3 is cost plus method. Number 4, transactional net margin method. And number 5, transactional profit split method. So the transfer prices in the income tax law in Mexico. We have here in Mexico the Article 76. Taxpayers who obtain income of those indicated in this title, in addition to the obligation established in other articles of this law, shall have the following: obtain and keep the supporting documentation in the case of taxpayers that enter into transactions with related parties with which they demonstrate that the amount of their income and deductions were made in accordance with the prices, amounts of consideration, or profit margins that they would have used or obtained with or between independent parties in compatible transactions. The documentation and information referred to in this section must be recorded in the accounting records, identifying in the same that they are related party transactions. We have the Article 76A. The taxpayer must provide the tax authorities with the annual informative declarations of related parties mentioned below. Number 1, multinational corporate group related party master information statement, which shall contain information regarding the multinational corporate group of the organizational structure, the description of the activity, intangible assets, financial activities with related parties, financial and tax position. Number 2, local related parties informative declaration, which shall contain information on the description of the organizational structure, strategic and business activities, as well as related party transactions, financial information of the obligated taxpayer and of the operation or companies used as comparable in their analysis. And number 3, country by country informative declaration of the multinational corporate group containing information at the tax jurisdiction level on the worldwide distribution of income and taxes paid, indicators of the location of economic activities in the tax jurisdiction in which the multinational corporate group operates in the corresponding fiscal year, which should include the tax jurisdiction, total income, distinguishing the amount obtained with related parties and with independent parties, pre-tax profit or losses, income tax actually paid, income tax incurred in the year, capital accounts, retained earning or losses, number of employees, fixed asset and merchandise. A list of all the entities comprising the multinational corporate group and their permanent establishments, including the main economic activities of each of the entities comprising the multinational corporate group, jurisdiction of incorporation of the entity in the event that it is different from its tax resident, as well as any additional information that may facilitate the understanding of the above information. So essentially there are 3 statements. Number 1 is the master file, number 2 is the local file, and number 3, country by country. So that is all for this short video. Thanks for watching. If you have any doubt, let me know in the comment. I'm willing to help. Thank you for watching.